With COVID and lockdown behind us, is it time to be buying stocks like Southwest Airlines LUV? We're going to find the answer in today's episode. We're going to find out what our perfect entry point should be for this company. We're going to take a look at the historical data. We're going to jump into their financial statements, look at their increases of their revenue year on year and their bottom line, their net income. We're going to jump into their balance sheet, look at their total debt versus total cash. We're going to, as always, look at the dividend safety. How safe are those dividends? And can they continue to pay the interest and the debt? We're also going to end the episode, as always, with our stock valuation model, finding the intrinsic value. And with our margin of safety, what is our acceptable buy price? Now, year to date, the company is up 19%. It is in the middle to the upper range of that 52-week range with a yield of just over 1.41%. Now, for those who have been holding the company for the last 10 years, we can see growth of 180%, which is very nice to see. We can see here straight after COVID, the drop all the way down towards the 20s, the low 20s, the 25, 26. And we can see it's slowly starting to go up. Now, the highs we can see here from 2021 were $63. So it still has some ways to go to reach that. Now, we're going to jump into their income statement and their revenue specifically. Typically, we like to see 3 to 7% year-on-year growth. Now, December 2018, they reported revenues of just under 22 billion. And in December 22, just under 24 billion. So whilst there has been growth over this period, we can see, and understandably, through that COVID period from December 2019, where their revenues were obliterated, and then it did pick up in 21 and it has picked up again in 22. So is this a stock where we think, it's going to turn around and it's going to continue to grow nicely? And do we take advantage of the price point? Well, we're going to find that out. Net income and their bottom line, December 2018, 2.5 billion. We can see, and understandably in that COVID year, that reporting year, a loss of 3.1 billion. And whilst it did pick up in December 21, it did drop further in December 22. So a slight worry that it hasn't managed to pick up higher than December 21. But we're going to take a deeper look in our financial metrics later. Balance sheet wise, in terms of their total debt versus their total cash, what we can see here, December 2018 reported cash and short-term investments of 3.7 billion. And in their latest quarterly report, a very nice, nearly 4 times increase to 11.7 billion. So a nice, healthy amount on the balance sheet. Now, comparing that to their total debt, what we can see here, total debt, December 2018, 3.4 billion, and more than doubled in their latest quarterly report at 9.4 billion. So let's take a look now at our financial metrics, see if they can continue paying that dividend, how safe it is, and is there room to grow and continue to pay the interest? So, Southwest Airlines dividend safety score of 60, making it borderline safe. Market cap around 23 billion, making a large cap. Now, some key metrics in terms of the recession. So if you believe we are heading into a recession, the last recession, 07-09, they maintained that dividend. Now, the recession sales during that period was minus 6%. Which was in fact above the average growth during the recession. However, even though it had above average growth, it did trail the S&P 500's negative 55% during that period, where they returned negative 65%. So do bear that in mind if you believe we are heading into a recession. Now, what we can see, there's quite a lot to take in from this graph. What we can see in terms of the last 20 years, that dividend has been growing at 12% year on year. Now, unfortunately, they did cut that dividend in December 21, what we can see here. However, it did then increase it in December 22. Not back to their previous historical levels, but it looks like they are continuing to grow that. And we can see here during this recession period, before and even after, they did maintain it for quite some time. And the last 5 years, negative 18% due to, we can see here, the drop from that COVID level. So a lot to take in. Some positives with the long-term dividend CAGR, some negatives in terms of their cut, but so far a lot to just take in and understand following further analysis. Dividend yield theory states companies undervalued when the current yield is sitting above the 5-year average. So with the 1.87% yield, it is above, making it undervalued based on this theory. However, we don't look at any models in isolation, so let's draw our conclusions at the end. Forward PE showing it to be essentially in line, reasonably valued, given the forward PE is in line with the 5-year average. Sector PE, however, is much higher, 18.1, so this does show another sign of undervaluation. And as I always mention, the 52-week price range and the current price is purely for information purposes. This does not mean it is overvalued if it's at the 52-week high, nor undervalued if it was at the 52-week low. Now, what we can see here is in terms of the earnings payout versus the free cash flow payout. If you've seen my videos, you know we like to look at the free cash flow payout as the earnings is susceptible to manipulation through accounting by management. But if you've also seen my pinned YouTube video, my 7 golden dividend metrics, of which one of them is below 60%, purely based on room for the company to grow that dividend double digits is our preference. So very quickly, earnings payout for the large part has been below 20%, with 2023 expected to be 23%, and the free cash flow likewise below 20%. We can see 2021 when no dividend was paid, and we can see that negative period during COVID. So a few things to take on board moving forwards depending on your thought process for the future of the company. Likewise, free cash flow per share is what I prefer to see. They essentially do mirror a very similar image. However, one interesting take, this is why I say I prefer the free cash flow per share. For 2023, they are expected $3.18 in terms of earnings per share. In terms of the free cash flow per share for 2023, essentially 10 cents. So just one thing to note there. It was increasing before COVID from 2013 to 2019 on both accounts. It did then drop understandably, did pick up after lockdown was opened, and then it has slightly struggled with the free cash flow. So do bear that in mind. Now, sales growth, as I mentioned, 3 to 7% year on year. What we can see here is fascinating. In fact, before COVID, it was really between 2 to 6%, not the worst, although I would prefer higher. We can see the massive effect COVID had, negative 60%, but even more interestingly, the effect once everywhere was open, 75% plus, 51% in 2022, and will be interesting to see the next 12 months projection. In terms of the actual number, what we can see here, 18 billion in sales in 2013, 24 billion in 2022. So nice growth across the period, and we understand why. This is one thing I always like to do. When you look at 10 years worth of data, it gives you a better idea of the business, the overview, and you can understand trends and reasonings why, as we've mentioned several times. Shares outstanding, when the company is returning excess cash to shareholders, putting money in your pocket by buying up shares. When it's the opposite, obviously we don't prefer this as companies are diluting our ownership. 2013, 718 million worth of shares outstanding. 2022, 642. So whilst they did essentially buy back shares consistently up to that COVID year, where they in fact did the opposite, slight worry because it is upwards trending from 2019 onwards, but I like to think at some point it will remain relatively flat. ROIC, again, return on invested capital, another one of my 7 golden dividend metrics, plus 10% is what I like to see, as it means there's room to grow that double-digit dividend, plus in terms of allocating that capital effectively. So what we can see here is for 2013 to 2019, plus 10%, very nice to see, and these COVID years, negative. However, 2022, 5%. I would like to see this go back up to the historical rates of plus 11% to 30%. Then we jump into the operating margin, again around 12% for most companies. We can see this was essentially what they had been doing up until 2019. 2022, 5%. Again, would like to see this picked up to historical levels moving forwards. And the same story with the free cash flow margin above 5%, which they had managed to do. Negative 1% in 2022. 2023 and 2024 will be years that I would be keeping a close eye on to get back to those prehistorical levels if they can. Net debt to earnings before interest, tax, depreciation, essentially showing that there is no real worries with them in terms of in terms of paying off their debt net of cash on hand. So no worries in my opinion. Net debt to capital, again, no real worries, purely for information purposes only. Then what we're going to do is move on to the stock valuation model. As always, if you're enjoying the content, do hit that like button, do hit that subscribe for continued content on your doorstep. If you want to grab a copy of this valuation model so you can run your own companies through this, do check the pinned comment. And if you want to join us on Patreon, do likewise check the description. Now, Graham's valuation, we put in the earnings per share. We have the growth rate, which is very, very high as expected by analyst estimates, and the yield on AAA corporate bonds. Intrinsic value at $50.55, showing some very nice upside to the current share price and well above that 52-week high. We then use multiples valuation model with companies in a similar sector and size. United Airlines, Delta, and American Airlines. We put their stock price and earnings per share. Once we get the PE multiples, we multiply the average by the EPS to get a stock price of $11.43. So very, very low. A reason for this is because the actual PE of Southwest Airlines is in fact much higher than the average of these three. Therefore, we see $11, which is significantly lower than the current trading price and well below that 52-week low. We then move on the dividend discount model. As mentioned, there were years where they stopped paying a dividend and years where they were, in fact, reducing that. So it gives an average growth rate of negative 32.5%. Now, personally, forward looking, I've gone for 6%. You could argue it is slightly higher. However, I think as we come out of the lockdown and COVID, and we see this effect in the results of Southwest Airlines over the next few years, I believe they will start to increase that dividend back to the rate it was historically. And what we can see when we take a look at the dividend growth, they were essentially increasing it by 12% year on year for the last 20 years. So this gives a DDM price of $38.16, essentially in line right now with the current trading price. Final model, the free cash flow model, we have the yearly free cash flows, the growth year on year, negative 37%. Again, the last 2-3 years did really hurt them. And we can see using our discount rate, the present value of these future free cash flows and the terminal value once we use the analyst estimate growth rate moving forwards. Once we add that with the cash and cash equivalents, subtract the total debt, we get to the equity value. Once we divide that by the shares outstanding, we get a DCF price of $90. As always, do hit that like button if you're enjoying the content and value is being provided, and do subscribe for continued content. Now, Graham's valuation and the other methods we've just run through will come into this intrinsic value as it is the average of the four methods. So we have $47.47 as the intrinsic value. You could argue removing the multiple valuation given how low it is, but for me, in my personal opinion, I think it's right to keep it in. Now, the current price around $38. Typically, for a strong company with a wide moat, nice historical financial metrics and forward-looking data, I'd argue a margin of 10% is justified. However, for this company, you could argue that a margin of safety of 20% is justified. For those looking for a margin of safety of 10%, it would currently be a buy. For those who, like me, would be looking to enter around 20% margin of safety, you'd be looking around $38, which is essentially the current trading price. So the current trading price, in my personal opinion, is giving you a margin of safety of 20%. Now, Wall Street forecasts the price over the next 12 months to hit $40, so they don't believe there is too much upside to the current share price. As always, let me know your thoughts in the comments. Are you a shareholder? Are you considering buying? Or are you looking to sell your shares? If you enjoyed the content, do hit the like button, do subscribe for further content, and as always, have a great, lovely day. See you later.